Marcus poured $10,000 into gold in 2015. He called it protection and a smart move, telling everyone who would listen that Bitcoin was just a scam for gamblers. Daniel put $10,000 into Bitcoin that same year. He called it the future and a sure thing, telling anyone who would listen that gold was just a dusty relic for nervous people. 10 years later, one of them is right, and one of them is catastrophically wrong. But here is the secret that neither of them saw coming. The thing that will eventually destroy both of their arguments has nothing to do with the price. The facts ahead will make you feel very uneasy no matter which side you choose to be on. To understand this, we have to strip away all the extra noise. Imagine two people in 2015. Both are 25 years old with steady jobs, no debt, and a small pile of savings. They are not rich, and they are not reckless. They are just trying to protect what they have built. Marcus buys physical gold, stores it away, and holds it tight. Daniel buys Bitcoin, moves it to a cold wallet, and holds it just the same. There is no trading, no risky bets, and no trying to time the market. It is just pure, simple holding. On the first day, Marcus's choice looks serious, ancient, and credible, while Daniel's looks like nothing more than a wild lottery ticket. However, the way you feel about these choices and the actual math behind them are about to disagree in a violent way. For those first 2 years, Marcus held the clear advantage in the court of public opinion. He could hold his gold bars in his hands, feeling their cold, heavy weight. When he showed them to his father nodded in approval. Even his grandfather would have understood the choice. Gold has survived every empire, every market crash, and every failing currency in human history. At dinner parties, owning gold was a serious grown-up answer to a serious grown-up question about safety. It commanded instant respect. Meanwhile, Daniel's investment was nothing more than a string of digital characters hidden behind a screen. It had no weight, no history, and no physical presence. When the price dropped 30% over 6 weeks in 2016, his coworkers laughed at him. His parents were genuinely worried that he had thrown his hard-earned money into a black hole. Because he had nothing to hold and nothing to show, his choice felt hollow. For 2 full years, the story was simple. Marcus looked like the smart, responsible one, while Daniel looked like a reckless dreamer. The gold answer felt like the only right answer. It was tactile, historical, and deeply respected by everyone who mattered. It provided a sense of comfort that digital numbers simply could not match. But the math had not even started yet. When the numbers finally began to shift, the reality of those investments would turn those once polite dinner party conversations into something very awkward. The safety that Marcus felt was about to be challenged, and the risk that Daniel endured was about to change everything. If you look at the basic headlines, the math seems simple. In 2015, gold was priced at about $100 an ounce. By 2024, it rose to roughly $2,300 an ounce. This represents a 109% gain. Marcus doubled his money, turning his initial $10,000 into about $20,900. This is the number you hear at a friendly meeting. It is the number you see in a polished YouTube thumbnail. It is true, it is real, and it sounds like an excellent result. Now look at Bitcoin. In 2015, the price was around $250. By 2024, it reached over $60,000. That is a 23,900% gain. Daniel's $10,000 became, at least on paper, something north of $2,000,000. These are the facts. There is no need for big reactions or exclamation points. You have a solid, steady double against a massive, life-changing increase. On a piece of paper, the difference is impossible to ignore. However, there is a hidden truth that neither of these numbers tells you. This is the moment where most people stop paying attention, close the tab, and go back to living their lives without knowing what actually happened. They think they understand the outcome because they see the final price, but they are missing the most important part of the story. Now we perform a reality audit. Those big round numbers from the headlines are not what either man actually keeps. For Marcus, the gold dream has a hidden weight. To keep his gold safe, he paid for a high-quality home safe or a bank vault, costing him $100 to $300 every year. Over a decade, that is up to $3,000 gone. He also paid for insurance, which takes another $200 to $400 annually. Then, there was the dealer spread, the markup he paid just to buy the gold in the first place, and the cost of finding a buyer who would pay a fair price when he wanted to sell. Once you account for these costs, his $2,900 turns into roughly $17,000 to $18,500. More importantly, gold is meant to preserve value, not create it. After adjusting for inflation, its actual growth over long periods is nearly zero. Marcus did not make a fortune. He just stopped his money from disappearing. Daniel's story is even more complicated. While his screen shows millions, that number is a trap. If he moved his money in or out of the exchange, he paid transaction fees. If he sold his Bitcoin, he faced a massive tax bill. At a 20% capital gains tax rate on his millions, he could owe the government over $400,000. Beyond the taxes, there is the human element. Bitcoin dropped over 80% in value during 2018 and 2022. Many people lost everything because they panicked and sold during those crashes. Others lost access to their funds through lost passwords or the collapse of exchanges like FTX. While Daniel's total could be $1.6 million after taxes, it could just as easily be zero if he made one mistake or panicked at the wrong time. The math says one thing, but the reality of holding the asset says something much more brutal. By the 5-year mark in 2020, the scoreboard told a sharp story. Marcus and his gold were quiet and steady. His $10,000 had grown to about $16,500 on paper, and after subtracting storage and insurance costs, he sat at a clean $14,800. He spent almost 0 hours managing his investment, his stress level stayed low, and he slept soundly every night. Selling his gold was a chore that took a few days, but it was reliable. Daniel's world was a different planet. His $10,000 had grown to roughly $120,000. Though after considering taxes and fees, he really had closer to $90,000 or $100,000. While his gains were massive, they came at a cost. He spent countless hours watching charts and fighting the panic caused by an 80% drop in value. His stress was extreme during the dark times, leading to many sleepless nights even if he felt great in 2020. He could sell his Bitcoin in minutes, but the emotional price of keeping it was very high. At year 5, Daniel was winning the math, but only if he had the nerves to hold through a near-total collapse. Most people simply did not. The few who survived the crash were rewarded, while those who could not handle the pressure had already left the game. Gold remained the quiet, predictable partner, while Bitcoin acted like a loud, wild storm. At this point, neither man had truly won. The assets were doing all the talking, revealing the true nature of their owners. One chose peace, the other chose a fight, and the scoreboard proved that both paths came with a heavy price tag. As we reach year 10, a vital difference emerges that changes everything. Gold does not compound. It simply sits there, preserving what you already have. A bar of gold in 2015 is still the exact same bar in 2035. It has the same weight and the same physical properties. While the price might rise, the asset itself never produces anything new. It is a store of value, not a source of growth. Bitcoin acts differently. It has a hard supply cap of 21 million coins that can never change. As more people use it and the amount of new supply is cut through set schedules, the same scarcity that makes gold credible is enforced by math. For Marcus, year 10 looks just like year 1, only with a slightly higher dollar value. For Daniel, however, year 10 feels like he is holding a completely different asset class. The boring, nervous, lottery ticket choice that people laughed at in 2015 has shifted. It no longer looks like simple gambling. Instead, it starts to look like early ownership in a brand new system for moving and holding money. While Marcus spent the decade watching his gold stand still, Daniel held an asset that changed its own nature as the world around it changed. The math of scarcity finally caught up, and the gap between a safe place to hide money and a new way to build wealth became impossible to ignore. Looking back at the full 10-year picture, the results are clear. Here is how the two paths compare. Category: gold, Bitcoin. 20,000, 20,000, 10,000, subs, 10,500, 10,000, 0 C1001, $500. Net realistic value. Net realistic. 1,007,000, 500,000, 00. 5 a total. 100. Liquidity moderate high. Counterparty risk low medium high. The honest verdict is simple. Bitcoin won by a margin that is almost impossible to explain. However, it only won for the small group of people who held their coins through 3 separate 80% crashes without selling. The vast majority of people panicked and sold while they were still in the red. Gold did not win the wealth-building race, but it did exactly what it promised. It won the race it actually entered, keeping capital safe, maintaining low stress, and avoiding any life-ruining losses. It was a solid, predictable choice that did what it said on the tin. In the end, the question was never which asset performed better on paper. The true question was always which one matched the risks you could actually survive. One man bought a comfortable night of sleep for a decade, while the other bought a wild ride that changed his life, provided he had the iron nerves to hold on. It is time to be fair to Marcus. Gold wins in specific critical scenarios where Bitcoin is at a disadvantage. When a national currency fails or enters a period of hyperinflation, gold has 5,000 years of proof that people will accept it as payment. Bitcoin has only existed for 15 years, which is a blink of an eye in history. If the power grid fails, the internet goes down, or global infrastructure stops working, Bitcoin cannot function. Gold, however, remains exactly what it is, a physical asset that does not need a digital signal to prove its value. Then there is the issue of human behavior. If you are the type of person who would have sold your Bitcoin during a sudden 50% drop, gold's lower ceiling acted as a shield for your own panic. It protected you from your own psychology. Furthermore, physical gold is simple to pass on. It transfers across generations without the need for complicated private keys, seed phrases, or confusing digital laws. Finally, gold offers protection against government seizure. While authorities have frozen crypto exchanges in the past, they have never successfully banned privately held physical gold. Gold is not wrong. It is simply a different tool designed for different problems. Calling it obsolete is just as intellectually lazy as calling Bitcoin a scam. The true enemy was never gold or Bitcoin. The real enemy was the incomplete number, the big, glowing gross return that ignores the tax bill, the painful survival rate, and the cold reality of how most people actually act during an 80% crash. The influencer always shows you the peak price, and the popular post always shows you a perfect 10-year chart. Yet nobody shows you the massive tax bill. Nobody talks about the 80% of buyers who lost their nerve, sold at the worst possible moment, and ended up with nothing. Here is the most important lesson. Before you ever compare two assets, you must build the net number. You have to subtract the taxes, the fees, and the costs of your own likely behavior under pressure. Gross return is just a marketing trick. Net survival return is the only number that actually matters. The math we used here exposes the truth behind the hype. If you think you already know how other investments stack up, you might be in for a surprise. Next, we are going to run this exact same math on a question that almost nobody wants to answer honestly. Index funds versus real estate. Using this same framework, we will see which path actually builds lasting wealth and which one is just another story we tell ourselves. The numbers are going to change the way you look at your money forever. True wealth is not just about the final number on a screen, but about understanding the hidden costs and your own ability to handle pressure. The best investment is not always the one that promises the highest return, but the one that aligns with your reality and helps you sleep at night.